gave up managing billions to become a better investor. Episode 14. This gentleman rarely prefers bonds. Hello. I thought I talked about the bond markets again today because we're kind of running up to an interesting end of this week. Tomorrow, as I speak, we've got the Federal Reserve meeting in the United States. In a couple of days' time, the ECB will be giving their latest views about bond policy and interest rates and related. And in just over a week's time, the Bank of England will be giving their views as well. And additionally, we've got updates from the central banks of Japan and China too, before the end of this week as I speak. So a lot of big central banks are talking, and the bond market is quite fascinating, really. And you would guess already by my title for this podcast that I'm not the biggest, never have been historically the biggest fan of bonds, but I have to accept that in a diversified, prudent pension fund or related portfolio, people have not only tended to have bond allocations, in many cases, certainly in today's world, when I look at prudently managed pension funds, allocations can be huge towards the bond markets, 80-90% in some pension funds that I've seen. And of course, we all know the reasons for that. ACRA is saying, well, in terms of if we're going to make a return, if our clients are going to have a pension fund which is sustainable for the duration of their life and related, we've got to allocate it to assets that we believe there's a very high probability that you're going to get a return. There's going to be something that we can predict. And clearly, I understand that government bonds, corporate bonds have that capability to them. And that's absolutely fine. I guess, though, and I've been sort of thinking more and more about this, when I think about the rest of the 2020s and into the 2030s, I'm actually wondering whether it is actually going to be prudent to have that sort of allocation that we're seeing in many pension funds today, or when we think about the classic 50-50 portfolio or the 60-40 split as it kind of got upgraded to a sort of 20 or 30 years ago, 60% equities, 40% bonds. Obviously, the previously mentioned one was a halfway split between equities and bonds. I actually think that is an overly high allocation to the bond markets. And I say that, and you may have heard in a previous podcast, I talked about how my sort of perceived correct allocation to the bond markets for a pension fund is your age minus 50%. I.e., if you were 55, 55 minus 50 equals 5 or 5% of your pension fund. And if you were 75, 75 minus 50 is circa 25% allocation to your pension fund. And so there's sort of an acknowledgement that bonds with their, certainly government bonds, carefully chosen corporate bonds with their more prudent allocation, their more lower risk potential profile versus the average equity, which I guess theoretically has more capability of going bust. Although, as I'm sure many of you are well aware, many corporate bonds, frankly, many government bonds in certain interesting countries around the world have struggled over recent times. Again, always useful to mention that over the last sort of, 150 years or so, there's only been a couple of equity markets that have actually managed to survive that time period. And actually, I think many bonds, the equity markets, of course, are the UK and the US. Frankly, elsewhere, whether you held equities or bonds, good luck. You're probably better off hoping to be holding a house somewhere which managed to survive wars or other disagreements or related. Clearly, the most smart thing to hold was something a bit more of either a fixed asset, something like my old favourite of gold, or something which was under the ground in the form of commodities or something like that. But of course, that's another story. But something actually we'll mention in a few moments' time as well. I guess my observation is this, though: the world is evolving and changing, and I say it from the perspective of my expectation that there will be continued a little bit of inflation in the 2020s and the 2030s, not the worrisome inflation talk that we hear a lot at the moment, which obviously people, and I understand it, sort of link with firm food prices and a sort of a cost of living crisis that they haven't seen or thought about for more than 15 years, in some cases even longer than that. But I think it's more a reflection of the fact that I worry about an aging population world with rising debt, or at least firm debt levels, certainly in certain parts of the developed world. And consequently, when you put together higher debt levels, higher supply of bond levels, an inflation backdrop, which I think in terms of what I would regard as true inflation, which is personal inflation rates. And as we all know, as I'm sure we've all seen, inflation hasn't just suddenly reappeared. Personal inflation rates have always been much more in that 3, 4, 5% level for, frankly, much of the last couple of decades or so. And at earlier times and certain infrequent times, even higher than that. But anyway, I guess my observation is this, that when I put together higher debt levels, Asian populations, the fact that there's a little bit of inflation, not too much, but a little bit out there, I actually think that even though bond yields are sort of a little bit high today, and if, as I expect we will see, big central banks around the world progressively over the next year will stop raising interest rates, possibly very soon in the United States, relatively soon in the UK with the Bank of England. I think the ECB will get there eventually soon as well, even though they'll stop raising interest rates and actually eventually start to cut them as some inflation targets are sort of moved to more closely. Is this a time when you should be loading up on bonds? Because, of course, we all know the old adage that if you have lower bond yields, you have higher bond prices. That's the nature of the structure, and so of course you get a reverse of those higher bond yields, lower bond prices that have sort of shocked people a little bit, or certainly many bond investors over the last couple of years or so, because all they've been used to, obviously, for the previous 40 years is lower bond yields and higher prices. And of course, it's quite amazing to see how both bonds or equities have done rather well over the last 40, 45 years or so for investors. A bigger surprise, clearly, for bond investors, as famously shown by the very high inflation of the late 70s or mid-late 70s. But frankly, if you put your money into government bonds in certainly 1980, 1981 time, and then suddenly you've been rewarded on it hugely. Clearly, you've also been highly rewarded by equities too, but I guess people would anticipate that a little bit more coherently. And of course, this is, I guess, the big debate for me. The big debate is, what is the world going to look like when we think about not just the rest of the 2020s, but even more importantly for any pension fund investor thinking about the 2030s, thinking about times when perhaps you may be thinking about drawing on your pension fund more overtly. My observation would be that in a changing world, a world where clearly developing countries are becoming more important, fantastic, but that means you've got to change some of your allocations too. I've talked before about the fact that thinking about global equities is ever more important for any investor. It doesn't matter whether you've come from the super successful America, whether you're only want to invest in the UK. Frankly, fortunately, the UK is a very international market in any case, just like the rest of Europe is. But you've got to be allocating much more to global opportunities. The rise of the developing world as they become a greater, bigger part of the global economy, the global split, the global influence. Unsurprisingly, this is where newer fortunes will fantastically be developed. And consequently, equity allocation in that space makes a lot of sense. What it means for bonds is a bit more complex. I think government bond yields in the developing world will remain something which is attractive, just because at the moment, we'll talk about China in a few moments' time, but in most countries, you've got generally higher bond yields than you can see in many developed markets, government bond yields, and you'd expect that the same with corporate bonds as well. And because of risk reward and related, you would expect that there's greater risks of problems, and we can certainly all cite a number of developing economies which have either actually defaulted or are coming quite close to potentially defaulting or having to take money from the World Bank or something like that to assist the IMF and related in order to assist their financial position. But my bigger issue is not so much whether you should be a bit like in equities, getting ever more global focused rather than perhaps, as we've seen over recent times, people being very much more focused in US centred or UK European centred assets alone. But I think when I think about bonds, my big concern is actually with the profile of developed market bonds. And I say that not because I think there's going to be a whole load of defaults. I don't think that the US government or the UK government, European government, they're not going to default or anything. I think the trouble is that you've got to think about where is the fair value of a bond yield on a medium-term basis. And I come back to my old favourite, which is, of course, the 10-year government bond, because I kind of feel that gives you that sort of medium-term perspective of what is the expected inflation and hence required yield level that you're seeing. And what I find kind of fascinating is that if I'm sort of vaguely correct that actually, despite the obsession with the 2% inflation rate profile in many central banks at the moment, fair enough, I understand why they're saying it, but I think it's, if you like, a little bit too overly focused on just inflation per se. That there are many inflation measures out there, and as I say, I prefer that kind of personal inflation rate, which I feel is always going to be running at that 3-4% sort of level. So therefore, if we kind of effectively are always having a sort of a 3-4% inflation level, then actually when I see what should a 10-year bond yield be in the United States or the UK or even in Europe, if there is also growth and a relative lack of risk of default and related, I would sort of say that at best, you should have a 3-4% 10-year bond yield too, which kind of suggests, when I look at today's levels, that bonds are going to perform a little bit. You'll see lower yields, higher prices. That's the way it works. So is there a sort of a return potential for bond investors? I think the answer is yes. Is it a massive, fantastic, wondrous return potential? Not particularly. And when I compare that against equities, and as I've mentioned, frankly, you could buy a bunch of UK or European or American equities, and most larger cap companies are getting their heads around the notion that they've got to be focusing much more globally nowadays. And obviously, of course, many already do, particularly in ones which are in the UK or in the UK European markets. You're getting that natural exposure. And when we think about what sort of total return you would expect from an equity, if there is global growth, and I think there will be global growth, I am an optimist in that sense. I don't think we're moving towards a world of deep geopolitical angst, a la sort of typical 1970s backdrop. I actually think that the world is getting slowly, it may not seem that way, and clearly we can all spot examples where that currently is not the case, but I think it ultimately is getting a place where governments are realizing wars are destructive at many levels. You still need to have that capability of defense and everything with it. That's important. But ultimately, to enter into a war or to start a war is generally leading to big economic challenges. And obviously, as we've seen most recently, I guess, or primarily with Russia, huge impacts on economies, and correctly, other countries deciding that they don't wish to trade as much with that country. They don't agree with what they've done and they want to push against it. And consequently, my future profile for the world is that we will see, despite aging populations in all countries, because of the fact that the developing world does have that advantage of a youthful population, a smart population, a population which I think will exhibit many of the growth sort of development shifts which we've all benefited from in the developed world over the last 2-3 decades, actually probably a little bit more. Consequently, I'm actually quite optimistic about global growth per se. However, what concerns me is that when I think about the developed world, G7 world, if you like, and obviously Japan is the best example of this, the biggest risk is that if you sort of focus too much on we want low inflation, we'll have slightly higher interest rates and the like, you end up with a lack of growth. And a lack of growth is quite an easy thing to happen and occur in more mature economies. And if you do get that, I think your risk is of negligible growth, of Japan-esque sort of, yes, ultimately low bond yields and low inflation, but also a relative lack of growth progress, or at least a disappointing lack of growth progress. And what that then means is suddenly equity markets, of course, are less of an attraction. Now, you're probably thinking, well, okay, so Chris has said, hang on, you're worrying about bond yields not being that attractive in the developed world, but now you've suddenly talked about Japan, and we all know that Japanese bond yields are negligible, and therefore, if bond yields are lower, shouldn't you kind of be excited? Shouldn't you be saying, well, this is fantastic, I can make a lot of money on bonds, they're safe, they're going to be paid, dividends are going to be paid, everything's going to be good, I'll get my original money back too, what am I worrying about? But here's the rub. The trouble is that if you get all of those matters happening, then I kind of worry about what the backdrop for the whole economy is going to feel like. And as an investor, it makes me concerned about how equities would perform and the like. I think I'd much rather be more comfortable with a world, certainly for the developed economies, G7 plus economies, which are focused on actually an acknowledgement that there might be a bit of inflation out there, but a bit of inflation when you also get a bit of growth and a bit of development is a better good thing. And particularly also when you avoid something which has been obviously a big focus of the Japanese markets, bond markets over the last 3 decades. And it's become a sort of a minor, well, I wouldn't say minor, certainly big in numbers, but it's become a sort of an issue in some economies either side of the Atlantic over more recent years. And that is, of course, the printing of money, the purchasing of government bonds and related. Quite amazed when you look at the Japanese bond market today, the amount owned by the Japanese government or the Japanese central bank. And of course, over time, that makes me wonder how that's going to ultimately play out. I'd much rather have a more, if you like, valid, reasonable system where bonds are still being sold. You may need to supply more of them. Certainly, you've seen more supply of UK government bonds in recent times for obvious reasons, and frankly, any other government I could mention. Look at the recent debate and discussions in the US, which ultimately led to higher debt levels and, over time, higher bond issuance. Same in Europe as well. I can live with that if you also get general progress and general sort of what I would call an underlying system which is kind of okay, which is sort of rational and still attractive for people to put capital to work, to invest in a country and related. I guess what I'm trying to say is this. Equities and bonds, and it's funny, I've got some data in front of me, which is about over about the last 100 years in the UK market, and there is a positive correlation between equity and bond markets. It's not huge. It's about just under 0.4 times, but it's what you would expect. I guess what I'm sort of trying to get around my way to sort of saying is that equities and bonds, it's not particularly strange that they kind of perform in the same direction, much more than you would think. I know that people think that bonds is the super safe, it's the thing that's going to perform if there's a recession or concerns. And there's some short-term truth in that. But the other problem is that the other things that hold back equity markets, the things which lead to lower equity valuation levels, general angst in equity markets and the like, I guess stuff that we've seen at various points, but obviously primarily and particularly in the 1970s, is concerns about, well, we have no growth, we have a bit of inflation, but we don't have any real capability for real pricing power or anything like that, or a limited amount of that. And of course, when you get that notion, there's a concern with, well, what's going to happen next, even in the bond markets? Will governments have to try and fund more debt? Will people want a higher bond yield in order to protect them against a potential little bit of inflation or general levels of uncertainty out there and the like? Things that we've seen plenty of times in broader developing markets at various points over the last few decades. And I guess when I look at Japan and I see that kind of low bond yield world, I also see that sort of low equity return world. Yes, I know that the Nikkei 225 has recently just hit a 30-odd year high, but the fact that it's taken 30-odd years to hit a new high, and that is obviously after a period of the market falling down sharply from its peaks in 1989 in the early part of the 1990s, it's kind of, that shows you how worrisome it kind of got there, and how long it took for people to realize that the average Japanese investment was interesting enough to allocate to. Japan has always been a great place to find selected, carefully chosen investments, and it still remains that way. I guess what worries me is that as we've had the maturing of economies in the rest of the G7 world, we'll get something similar there. And that's why I feel you've got to be much more of a global investor nowadays. That is where more growth is. There is always going to be some risks, some obviously geographical challenges and the like, but it's far from impossible. And certainly, I think my perception is that also certainly very true about the States. They don't, American views, I feel, are generally there's a concern if there's too much for focus on aggressively on just low inflation, and hence an acknowledgement that there might be a low period of growth or a steep recession or the like to achieve that. I feel that, as you can see by Federal Reserve formal policy orientation, it's more of a two-way split there, in the sense that you've got to focus on not just inflation, but also things such as jobs and general, what I would say, broader progress in the economy. And I kind of feel when I think about that a more likely scenario for the rest of the 2020s and into the 2030s for bond investors is that you've got to accept that you're probably not going to get super low bond yields, Japan-esque style, because I think people will acknowledge that that's actually not that wise. That all that's telling you is that both bonds and equities are going to be poor value, and sadly, cash may be safe, but actually you're still not be making much of a return there either. Initially be okay, but as we've seen in Japan over the last 3 decades, again, people who had money in cash, yes, it didn't do anything overly negative, but it made them no money either. By contrast, when again we go back to these 100-year-old correlation stats, unsurprisingly, what asset classes have negative correlations with typical gilt movements or general government bond movements. And of course, inevitably, you're looking at commodities and gold. No great surprise there. These are, for me, classic areas to look at for what I would regard as diversification. I guess what I'm trying to say is, when I go back to my preferred allocation for pension funds over the rest of this decade and getting into the 2030s, it's back to the notion of have your chunk in equities. I think that's great. Have a few bonds. If, once you do that sort of work on your age minus 50, that's your allocation to bonds. That's fine. I understand that. It's not a question of having a bunch of cash with the rest, though. Think about those true alternatives. The classic ones I've talked about, the commodities and gold, but also infrastructure. I think that kind of relevant world, particularly in a changing world, maybe you can find some other ones which are linked with the shifting world that we've got. And then inevitably that brings us back to the emerging markets world, or developing markets world, which clearly should be reflected in equity allocations, but may find some other allocation orientations too. Let's face it, when you look at commodity, underlying rationale for commodity demand of pretty much any commodity you might mention, the role of the developing economy, aligned with obviously a shifting backdrop to the structure of the way the world is oriented, is having an impact there. So you put all of that together, and I guess what I'm thinking is that bonds don't particularly attract me. Yeah, I think that they are a little bit cheap today. When I look at bond yields today, and I go back to my old favourite, the 10-year government bond yield, it does look a little bit cheap versus what I would regard as a likely medium-term inflation rate, Obviously, the almost zero likelihood that any G7 plus economy is going to default at any point that I can see over the next, few decades or something like that. But am I truly regarding it as a massive total real return kind of allocation source? And the answer is not particularly. I'd much rather have my money orientated in a bunch of equities, particularly from a more global perspective. But obviously, there's plenty of requirements continuing in the developed market economies too. That important commodity stroke gold stroke infrastructure kind of allocation too, and maybe some other alternatives that you can think of as well. I guess that's the nature of a prudent pension fund allocation. Bonds have a role, but perhaps not as big as people are thinking. We'll see what central banks say with their updates over the next few days as I talk. And obviously, if I wait a week or two, we can talk about what they actually did do and what they might be doing over the next policy meetings and the like. I guess what I'm trying to say is that I think the prudent investor goes beyond just this simple 60-40 portfolio split or something. I think it is a more complex world today, but good complex. It's not a bad complex. It's a good complex, mainly because we are getting smarter. I think the world is getting better. I know it doesn't feel like that sometimes, but believe me, I think it is getting better. I'm not worried about AI. We talked about this in a previous podcast. That excites me. And sure, you can find certain leaderships who are strange, in fact, actually extremely not just corrupt, but extremely wrong at many levels. And again, we've talked about some of these matters before. But ultimately, as I think more politicians are learning, particularly in parts of the developing world who perhaps are not what would appear to be aggressively oriented to a system which is allowing complete freedom of votes and related, as their own sort of country becomes, more people own their house, more people have wealth, more people have things such as a pension fund or some kind of something from an insurance product or something like that. As awareness of what's occurring in the world sort of builds, I think there'll be a greater acknowledgement that the world is changing, but changing in a positive way. I think, fortunately, the risk of aggressive, non-justified wars are starting to become less apparent. I know, again, that's a difficult comment to make when we've seen some clear examples of very more than silly behaviour, horrible behaviour, completely negative behaviour in certain countries over recent times. But I think the impact of those is becoming more apparent too. And a bit like how we've seen, sadly, issues of war and challenges at all points in the world's history, let alone over more recent times over the last 50 years. And there is always an importance for defence and related matters for pure security reasons. Fortunately, I think from an investor's perspective, the rationale for even countries that we would regard as not necessarily beyond the pale, but problematic, ones which we don't really understand, or others in the broader world feel uncomfortable with, I think we will see some positive shifts of that. And that's good news for investors for obvious reasons, particularly those of a more global orientation. I guess what I'm trying to say is there are plenty of opportunities out there. Don't feel the need to be massively, hugely into bonds. When I look at those pension funds, those corporate pension funds with 80-90% in bonds, it is very prudent, but I'm afraid that you're going to be a bit disappointed, I feel, with some of the returns there too. Would I be buying bonds today? I guess I'm trying to say is I do think they're a little bit cheap. I think by the end of this year, over the next 18 months, if you like, you will make money in bonds. Do I think you make still more money in equities? Yes, I do think you will. Do I think there's, what's your alternative angle? How do you want to mix your asset? that would bring me back to the world of selected commodities and particularly gold, of course. But, when has that not changed? That's always been the case for me, I guess. I guess what I'm trying to say is the world remains an interesting place. And I guess we'll just need other podcasts and more time to kind of develop some of those thoughts even further and see whether some of those musings about what central banks are thinking about their policy over the next few days, re-interest rates, as aforementioned. If I was the Fed or the Bank of England, I wouldn't be raising interest rates. I think maybe the ECB probably does it once or twice more. They were quite late to the game. But honestly, I think it takes a long time for higher interest rates to have their full impact, perhaps a little bit longer than many central bankers even think. And I would chill. That's my official view, particularly for the Federal Reserve and the Bank of England. We'll see whether that's smart or not over time. But anyway, I think I better draw a line there. But thanks very much for listening, and we'll speak again soon. Bye-bye.